Hi, in today's session we're going to take a look at one of the most important topics in finance, risk and return. Risk and return is fundamental to everything that we do in finance. It's fundamental to the valuation of companies, the valuation of stocks, understanding whether we're creating real value for our investors or just creating a much more risky business and giving a less than fair risk-return trade-off. The gentleman in this image provides a good example of that risk-return trade-off. I don't know about you, but I would have a limited risk tolerance, and that's one of the terms that we're going to use in this area quite a bit. Jumping off a mountain, wearing a squirrel suit, and trying to throw yourself at the ground as hard as you can and not hit it, and waiting until the very last minute to open a parachute is definitely an interesting measure of risk tolerance. In this case, the reward or the compensation for taking this risk might not be entirely clear to you and me. Perhaps he's getting some kind of a payment, but it would have to be a lot of payment in order to justify that type of risk. You can see from the look on his face that he's definitely enjoying this. There's some kind of a non-financial or non-pecuniary type of reward, something we generally don't have to discuss much when we're talking about finance. The risk-return trade-off is one of the other critical ideas. How much extra risk are you willing to take for a certain measure of extra return? And we always assume that that relationship is going to be an increasing one. In other words, increasing risk requires increasing return. If we're not observing that kind of a logical relationship, we're in an irrational investment situation where investors are willing to take on higher risk for lower levels of return. That natural type of risk trade-off understanding is called being risk-averse. In other words, we require higher levels of return for higher levels of risk. Statistically, we can see that that type of a risk relationship is described by these two probability distributions. And you knew there was a reason why you had to study this stuff in statistics. Well, this is it. In each of these distributions, the red one represents a stock with relatively safe returns. You can see the expected rate of return for both of these investments on the bottom axis is 15%. So either way, you expect to receive 15%. That's your expected return. But for stock A, you can see there's a high probability. There's a lot of observations that are clustered around 15%. So occasionally a stock will perform badly and perhaps you go down to a 0 rate of return, or on a really good day you get a rate of return of 30%. There are a few outliers, a few values in the tail, but you can see the majority of the returns are clustered in closer to 15%. Stock B has a flatter distribution. In other words, there are fewer of the observations, fewer of the experiences that are close to 15%, while more of them are out in the tails. You can have a negative 15% rate of return or a 45% rate of return, and even higher in some of the outlying cases. The nature of these probability distributions is fundamental to what we do. Being able to choose a safe investment like stock A or a riskier investment like stock B. But remember, in all of these cases, the risk has got two tails. There's an upside and a downside. In other words, if we accept that we're willing to take risks in order to receive the upside returns, then we're also likely going to receive the same kind of risks on the downside. You can see from our textbook examples, there are two stocks that are provided, stock M and stock B. Stock M, as it happens, is a microbrewery, hence the M. And stock B is a big brewery. They take risks just like the microbreweries do, but the nature of risk is different, even though they are technically in the same industry. The big brewery has got a certain amount of market risk. They've got other risks like product risks, and they've got financial risks, and they've got operational risks. But let's just focus in on the market risk for now. For the big brewery, their risk is tied to things like, will my drinkers, will my customers have their hockey team make it into the Stanley Cup playoffs. If we have a season where there are no Canadian teams in the Stanley Cup playoffs, or perhaps coronavirus hits and we can't finish the season, then there's going to be a real fall in the level of consumption, and that would be a problem for the big brewer. In fact, for all brewers, that would be a problem. Now, that's certainly a market risk. There are other market risks. Having a rainy summertime season when they expect to sell a lot of their product, that could be a problem as well. The microbrewery may take on some of those risks, but as well as those risks, there are going to be risks like producing a product in an ever-changing marketplace that doesn't hit the target. For example, if you produce a new beer, a chocolate porter, and all of a sudden you discover that everybody wants a coconut porter, or they're drinking pale ales, then you may have made a mistake in the market and you're taking a much greater risk because there is much more variation in the product and much more variation in the market. You can see that in the nature of these probabilities. For example, if we have equal probabilities of strong and weak and normal situations, and that's not given, but it's just say, assume it's so in this case. We have a 40% chance we'll have a normal year, 30% chance we'll have a good year, and a 30% chance we'll have a bad year. And of course, those probabilities add up to 100%. In a normal year, both of these products are going to produce a 15% rate of return. The microbrewery in a strong year will have a 100% rate of return, and the big brewery in a strong year only 40%. But on the downside, the microbrewery in a bad year, 70% loss, and the big brewery in a bad year, a 10% loss. Now, we can chart those using these type of bar charts called histograms. And we can see that with only 3 observations, we have a 40% chance on the left-hand axis for the microbrewery of having a 15% rate of return, and a 40% chance for the big brewery of a normal rate of return. The downside, 30%, was minus 70% rate of return, and on the upside, 100% rate of return, 30% upside. And here we have the upside, the downside, as we described them before, 15% up and 45% up and 15% down. If we turn those histograms into a continuous function, as we've done here, essentially describe those numbers with a line rather than as a histogram, then you can see we see these probability distributions. The big brewery with a high probability of having a 15% rate of return, and the chances of it having a return below 0 are very low. There is very little value underneath the brown curve that is to the left of the 0. Similarly, above that 45% rate of return, there's a very small amount of value in that, and in other words, very small likelihood of having that kind of return. The microbrewery, on the other hand, has got a much better chance of achieving both the lows and the highs. These banana-shaped segments that are over top of the brown line and underneath the blue line represent the increased risk of that type of a business. So invest in the big brewery. Well, you're more likely to actually achieve the 15% rate of return, but you're not very likely to achieve those really high upsides. Compare that to something like a pharmaceutical company versus a biotechnology company. Pharmaceutical companies produce pills and they sell them in established markets to established clients. The rate of return is going to be probably, on average, lower than that. In other words, the distributions don't have to match than that of the biotechnology companies. But the biotechnology companies have a very high chance of producing negative returns, and in the short term, not even as high a chance of producing a good return, but in the long term, a high return when eventually they hopefully find the right drug. If we're looking at return's easier to calculate. We're only going to spend a few minutes talking about return. Risk is much more interesting and much more difficult to understand. In fact, we'll go beyond today's session and look at part of that return later on. The rate of return that we expect to receive is usually notated by having some kind of a hat or a line or a tilde symbol over top of the R. That tilde is the wavy line over top the R. In all of these cases, it essentially says that's not the return that we know we're going to get. It's the return we hope or expect we're going to get. And a simple way of measuring that would be to say that the rate of return that we expect is essentially going to be determined by the observed rate of return times the probabilities of the return for each period into the future. So we're going to take the sum of all of our observations. In the last case, you could see there were only 3 possible observations. There was an upside, a downside, and average. So we had 30% chance of an upside, that was the P, or the probability, 40% expected return or normal return, and 30% downside rate of return. And the rate we receive in each of those probable cases is given as well. So we have 100% on the upside for the microbrewery, 15% for the average year, and minus 70 for a bad year. If we take the weights times the probability, and that's what we're doing in the main part of the equation, we take the weights times the probability for each of those and sum them or add those together, and that'll give us an expected rate of return for the microbrewery of 15%. We do the same thing for the big brewery. We also get 15% rate of return. It doesn't have to be equal, it just happens to work out that way in our textbook example. Risk is always going to be more complicated, and this is why we need to understand things like standard deviation and variance. You can actually observe standard deviation in your classes. Some classes, everybody gets a B+, and there's very low standard deviation. It's perhaps hard to mark that class, or perhaps there's a lot of group work, and courses like that tend to end up with a lower standard deviation. Other courses where the answers are right or wrong, like accounting or finance or math, have higher standard deviations. So we get a lot more A pluses and a lot more Fs and C minuses and Ds and so on. So the distribution's a lot broader. Standard deviation describes the difference between the observed and the expected. And to jump down to the bottom part, oh, by the way, the small delta that we use is our standard notation for standard deviation. And when we take the standard deviation squared, that's the variance. So the standard deviation is the square root of the variance. Sigma squared, okay, that funny looking 0, the sigma squared is our variance measure. So what is standard deviation? The main part of standard deviation comes from this one relationship here. That's the difference between what we expect and what we see. If I'm expecting the average height in one of my classes to be 5'8", and I see somebody walks through the door and they're 6'4", 6 inches taller than the average. So my expectation would be 5'8". My observation, Ri, would be 6'4". So the difference is going to be +6. Now, the second person walks through the door, they're 5'2". My observation also says that the difference is 5'2" minus 5'6". So I end up with minus 6 inches. Now, since we don't want those things to cancel out, we square all of our observations. So in both of those cases, they come out to be 6 squared, or 36. Where we're dealing with an experiment with equal weights on each of the observations, we wouldn't use probabilities, we would just take the sum of all of our observations. But here we're using probabilities, so we'll multiply that by the probability and take the sum of our observations times the probabilities, and that'll give us our standard deviation. Works well for a simple example like the one we've been using so far. You can see that our expected return in all cases was 15%. First observation for the microbrewery, a good year, 100% rate of return. 100 minus 15 is going to be our first number. We're going to square that to get rid of the sign and multiply it by the probability. Second observation, 15 minus 15 cancels out. We don't need to worry about that one. And our third observation, minus 70 minus 15, square that, multiply it by the probability. And so we take the sum of all of those, and then we take the square root to turn that variance that we've observed into a standard deviation, we can see our standard deviation is 65.84%. We do that for the big brewery, same numbers we've seen before, and our standard deviation is much smaller at 19.38%. That tells us, using the measures of standard deviation that we discussed in statistics courses, that the distribution, 3 standard deviations away from the mean, which includes almost all of our observations, those standard deviations are going to be much bigger. Each standard deviation will be 65%. So it's a much bigger and much flatter distribution for M than it is for B. Now, you remember I mentioned risk-averse at the very beginning of our session. We naturally assume all investors, and in fact all rational people, are risk-averse. I once asked a professor what's the opposite of risk-averse, and he clearly didn't know. He hadn't thought about this one. He said, it was a small class, he said to everyone, go away, come back next class, you guys tell me what you think risk-averse is. Now, mind you, we didn't have Google then, but what is the opposite of risk-averse? I suggested risk-perverse, which got a good laugh, but clearly wasn't the right answer. And after a lot of discussion, finally the professor said, no, the opposite of risk-averse is stupid. Well, irrational is probably a better word. And in all of economics and finance, we assume people make rational decisions, which of course may be itself irrational. So we say a risk-averse investor will consider risky assets or portfolios only when they provide extra compensation for that risk through a higher risk premium. And risk premium is another important term. How much extra you get for taking the extra level of risk. So that's the excess return between the return on a risky asset and a less risky asset. There are several components to risk. We're going to focus today on part of that list. If we have a risk that everybody faces, absolutely everybody, including all types of businesses, the banks, insurance companies, consumers, we all deal with a certain type of risk. It affects everybody, perhaps not exactly equally, but to a large degree. Things like interest rates, inflation, bad news about the economy, a pandemic. Those are all things that are going to affect every business. And so we describe those as a type of a market risk. They affect everybody in the market. Some of those other type of market risks that are going to affect most, but perhaps not all businesses equally, would include things like exchange risk. If you use imported products or if you have foreign markets, you're taking foreign exchange risks. Perhaps you're also dealing with political risks because you operate in another market. So everybody bears part of that risk, but some companies more than others. So market risk and the quasi-market risk are over on the right-hand side of my chart. On the left-hand side of the chart, we have things we describe as firm-specific, or another term that we use is idiosyncratic, things that affect one company much more than others. Our decision to build a project in Nanaimo, our decision to enter into the market in Zimbabwe. Those are firm-specific things that are going to affect us and not going to affect our competitors. So those things, those specific decisions made by management that affect our business are firm-specific or idiosyncratic. We may also have things that are quasi-idiosyncratic, things that are going to affect a certain industry, perhaps uniquely, compared to other industries, and that's the competition may be stronger, weaker. There may be a consolidation within the industry. So those things would be more firm specific. And of course, somewhere in the middle, we have things that are perfectly quasi. They're partly firm specific and they're partly going to be market specific. For the purposes of instruction, we tend to focus mostly on things that are entirely market specific or market risks and idiosyncratic risks. And that's what we're going to be talking about today, mostly the market risks. So coming back to return for a second, when we look at the expected return comes from a couple of sources. One of those sources is going to be the cash flow or the yield from the project. If we're investing in a bond, for example, as we saw in our last sessions, we receive a coupon payment or an interest payment. If we invest in a company, we get a dividend payment. So that D sub N represents part of our return. But a lot of the return from many investments, especially those that don't pay dividends, comes from the price appreciation, or a capital gain. So in that case, we would say, what is the improvement in our price from this period from the previous period? So if we had a price of let's say, if I can just scribble over my margins again, if I had a price today of 110, and my price at the beginning of the year was 100, then I've made $10 capital gain. Let's say that I also had a $10 dividend. That means that 110 minus 100, 10 plus 10 gives me a $20 total gain. Is $20 good? Well, $20 return on $1 million wouldn't be impressive. $20 return on our original investment of 100 is 20 divided by 100, or 20% rate of return. And so that's our normal measure of the actual return for a specific investment at a specific point in time. We can also describe that, if we're looking at many different investments, as the expected return at one point in time divided by the number of time periods. So that would be our average or expected rate of return. And we use the notation E, brackets R, to say expected return, or we use an R with a hat or a bar or a tilde symbol to show us that it's the expected rate of return. An example, again from the textbook, and a very simple one, and certainly not up to date. It says we've got two companies, Boeing and Home Depot. Boeing, over the 5 years that we've observed the company, 1, 2, 3, 4, 5, has had rates of return that were as low as minus 33% and as high as 66%. And so if we take the sum of those, 70.2, and we divide that by the number of observations, we can see that the average or expected rate of return to Boeing would be 14%. Now, clearly that's not up to date considering the things that are going on at Boeing right now. Home Depot, on the other hand, maximum return of about $108 million and a minimum return of about $4 million. So the sum of the returns over the 5 years, 209.4 divided by 5, gives us about a 42% average rate of return. So that becomes our expected rate of return. And if this is total return, that means that those values include the capital gains and also the dividend payments. Now, nobody invests in just one thing, or at least reasonable, rational people tend to invest more in a portfolio. And often we temper the returns and the risks that we get by managing a portfolio to minimize our risk. And so that's why we talk about risk usually in the context of our overall portfolio of investments. For example, if I'm somebody who uses gold, I need to buy gold, I might invest in a gold mining company because whenever the price of gold goes up, the value of my gold stocks go up, but also the cost of manufacturing my gold product is going to be affected. So whatever I gain from the stocks, I lose from my cost of manufacturing, or in my higher cost of manufacturing. And so that would be a portfolio effect, or a type of a hedge, we'd say. Now, investors usually hold portfolios, not an asset of only one kind. And of course, the smallest a portfolio can be is a portfolio of two investments. And that's typically the type of example we see in a textbook. So the risk return of an individual asset needs to be understood in order to see how it fits into the portfolio. But much more important in the long term to see the portfolio risk and the portfolio return. The expected return from a portfolio is just the weighted average of the returns in the portfolio. Very simple to calculate. The risk, a little bit more complicated. So if we have two stocks, for example, X and Y, each has an equal investment of $25,000. So our portfolio's got a total value of $50,000. The expected return of X is 11%, Y is 7%. The rate of return on the portfolio then, expected rate of return on the portfolio, or R sub P with the bar over top to remind us it's expected, would be the weight of X times expected return of X plus the weight of Y times expected return on Y. So 50% of our investment, that's 25,000 over 50,000, or 0.5, times 11% rate of return to X plus 50% weight times 7% rate of return gives us an expected return to our portfolio of 9%. Very simple to calculate the portfolio returns. The risk, as I mentioned earlier, a little bit more complicated. The return or the risk for a portfolio, or would say the sigma for the portfolio, the standard deviation of the portfolio. A standard deviation is not the weighted average because there's going to be some interrelation or some interplay between those two things. So as well as using the Greek letter for the small sigma, in this case we're also going to use the Greek letter rho. And we pretty much use a large part of the Greek alphabet in order to teach finance. So to calculate the variance and then eventually the standard deviation of our portfolio, the variance is the sigma squared. So the variance for our portfolio is equal to the weight of X times the standard deviation of X, and we square that, plus the weight of Y times the standard deviation of Y squared. And those things are pretty much intuitive. How much risk do we get from X and how much risk do we get from Y in proportion to the weights within our portfolio. This third term, though, is a much more interesting one. So this part here, the third term, tells us about the interrelation between X and Y. So to do this, we take a look at the weights and the standard deviation of X and Y, and we multiply them by this measure. And that's our correlation coefficient. The rho represents the correlation coefficient between X and Y. If two things are highly correlated, perfectly correlated, we give that relationship a value of 1.0. Perfectly, positively correlated. If they are opposites, in other words, if one goes up, the other goes equally down, then that would be a negative correlation coefficient, and we'd give it a factor of minus 1.0. If we give it a value of 0, we'd say there's no relationship. They are perfectly random relative to each other. One doesn't have any effect on the other. And so the overall risk in the portfolio largely depends on the relationship between these two types of risks. And so if we want to have risks that completely offset each other, then we would search for an investment which had a negative correlation coefficient, not perfectly positively correlated. The standard deviation, therefore, of our portfolio is the standard deviation portfolio equal to the square root of the variance. And remember, this was the variance that we calculated for our portfolio. To use a very simple example, imagine you've got two stocks. You've got investment A and investment B, and the black line represents the overall portfolio. These two stocks do exactly the same thing. Imagine you've bought shares in CIBC and Royal Bank of Canada. Both big Canadian banks largely operate the same way. They have a good year because of stable interest rate environments and heavy borrowing and all these other things that make banks successful, lots of transactions and transaction fees. If they have a good year, they both do well. And if they have a bad year, they both do badly. Therefore, our portfolio made up of two very similar investments is going to have the same volatility, same uncertainty as our investments. Imagine a different portfolio, and here perhaps we have two different companies, an oil company and an airline. Airlines have many important costs in their business that tend to vary or fluctuate with volume. The cost of their equipment is pretty much standard. Their cost to carry passengers is standard. Their revenue varies with the economy. But the one big expense that they can't control is oil. So if the price of oil goes up, quite often airline stocks go down. And if the price of oil goes down, the price of airline stocks goes up. Here we've got a second investment in an oil company, and the price of oil goes up, and oil stocks go up. And so we have a common relationship with oil. The inverse, in this case, exaggerated, perfectly negative correlation between these companies essentially means that our portfolio maintains a stable rate of return that's essentially 15%, stays at 15%, while our two individual investments go up and down, our portfolio earns a nice stable return. In fact, it would suggest that airlines would be better off if they went out and bought oil refineries, and in fact, Delta did. It was a good idea in theory. It turned out to be a terrible idea because there was an oil refinery fire in the Gulf of Mexico refining area in the States, and insurance rates went way up, and Delta got badly burned, but the theory worked perfectly. We don't like to calculate portfolio risk with a pencil or a paper just because it's very messy. Here we've got a simple two-asset portfolio with one correlation term. Essentially, this is like working with matrices, and so the calculation gets very complicated with 3 investments, hugely complicated with 4, and pretty much, well, not quite, but not practical if we have to do 5 or 6 or 10 investments. But in our simple example, we have 2 assets, and A and B, and they have a correlation coefficient of 0, and the weight of A in our portfolio is 75%, and the weight of B is, well, 1 minus the weight of A, or 25%, and that's our portfolio. The standard deviation of A is 4%, the standard deviation of B is 10%. To calculate our variance now, remember sigma squared is the variance, we'll take the weight of A times, well, you've seen this formula before, so the weight of A squared is 75% squared is 0.5625, and 4%, our standard deviation squared is 0.16%, and the weight of B is 25% squared, or 6.25% rather, and the risk, or the standard deviation of B, is 10% squared, so that's 1%. Total calculation of the correlation coefficient term is, well, it's actually really simple. We take those numbers 2 times the numbers that we saw before, but remember that row was 0. So this entire term ends up being worth 0. Simple calculation. So the variance of our portfolio was 0.15%. The standard deviation of the portfolio is the square root of 1.5%, or 3.9%. And so that would be our answer. We would expect to see our portfolio have a standard deviation of 3.9%, pretty close to the minimum standard deviation with A, and that has 75%. And just because of the calculation rounding and errors, we end up with slightly different than 4% value. Essentially, we say that we try to create a portfolio which is an efficient portfolio. In other words, we end up with a minimum risk for the maximum level of return. Our portfolio then is a collection of assets which produces the minimum rate of risk for the maximum rate of return. We describe that within something called the mean variance space, and I'll show you an example of that in just a second. So the return offset by risk. And any portfolio that minimizes risk for an expected level of return would be considered efficient. That's part of our efficient set of investments. Investors choose among the efficient set of investments for the right level of return relative to their risk tolerance, or to their ability to accept the risk. And I can kind of show you how that works. Here on our blank chart, you can see we have our portfolio returns, so high returns, low returns on the left-hand scale. Across the bottom, we have the level of risk, starting off with 0 risk. So 0 risk, you're probably expecting to have a really low rate of return. Really high level of risk, you're going to expect to have a very high rate of return. So you can already see that our expected trajectory on this chart is going to lead from the bottom left-hand corner up towards the top. If we're able to operate up here in this top corner, we use this special symbol for optimum. That's where we'd like to be, low risk and really high return. And if you're down here in this other corner, we have, our unhappy face. Now, if somebody said, what can I invest in within this space? You could say, well, there are all these interesting portfolios that are presented to us by our advisors. You could invest in that portfolio, which gives us about a 7.5% rate of return for a standard deviation of about 3%. Or perhaps you could invest in this one that's offered by their competitor, a little bit lower rate of return, a little bit higher level of risk, or perhaps this one, a little bit lower level of risk for a slightly lower level of return. And as we start to look at all of the different competing options, we kind of fill in this space with our alternatives. And what we'd really like to see is an alternative up there, but it doesn't exist. And we see lots of possible alternatives that might be way down here that aren't terribly interesting because they're giving us higher levels of risk and lower rates of return. What we discover after looking at many different alternatives of stocks and bonds and money market investments and so on, that we have got essentially, we have a line that represents the best possible alternatives of risk and return trade-off. So any point on that line represents the highest level of return for the lowest level of risk. And there's nothing above that line. That would be beyond the efficient frontier that we call it. And that's the name of this line. That becomes our efficient frontier. And so our efficient portfolio is going to be at some point that's on this line. Now, we'll also know that you can keep your money, essentially keep your money in the bank, not invest in any of these crazy things. And let's say that we have a risk-free investment that's putting your money in government bonds. And in this old example, you never get these rates now, but in this old example, I could put my money into 5-year government bonds and earn a 6.5% rate of return. That's essentially my risk-free rate of return. Or I can invest my money in a portfolio that is essentially, with excuses for the drawing difficulties, the point of tangency between this curve and my risk-free investment. And that's essentially my market rate of return. That's the rate of return I can get by putting my money into an efficient investment, which is going to be consistent with the risk-return trade-off line. And that line that I've just drawn, I also describe as the security market line. And it represents fair rate of risk-return trade-off. So any point on that line, if I'm way over here on the right-hand side and I have a high level of risk, say, a standard deviation of 7 or 8%, I expect or would require a rate of return of 9% or 10% in order to say I've got a fair rate of return. If I'm way over on the left-hand side, and I'm only willing to accept a 1% standard deviation, I shouldn't expect more than a 7% rate of return. So any place on that line is theoretically possible because of one other trick that we can pull. If we want to be over here, we can't find a portfolio that is going to give us that return. But what we can do is put part of our money into government bonds and part of our money into a market portfolio. And by market, I mean something like the Standard & Poor's 500 index, or the TSX, the Toronto Stock Exchange Standard & Poor's index, or the NASDAQ index. So I could put my money into a market portfolio with 50% of the money, and 50%, say, put that into risk-free government bonds. And so my portfolio with two types of investment would be to the left of the efficient frontier. I could also theoretically operate way over here on the risky side. I don't just I could find a new type of investment like venture capital that might operate over there, but I could even buy lottery tickets, and that would also give me that kind of a high risk and potentially high return in a very extreme case. But I could also put 100% of my money in the market portfolio and then borrow money from the bank, what we call margin, and use that to double my investment. And that would put me to the right-hand side, double the risk and double the return. So by efficient portfolio then, we're essentially saying that this is going to fit our security market line, the risk-return trade-off line. We would love to operate above the line because that would give us a rate of return that's essentially or theoretically impossible. And we don't want to operate below the line because that is giving us a rate of return that is not fair compensation for the level of risk that we're taking. Now, essentially, this is a topic that we cover in a chapter or sometimes two in our finance text, but we don't cover in detail in this course. One of the things that we do in order to create a portfolio is to become diversified. And starting off with some of the work that was done in the 60s and 70s by people like Harry Markowitz, in fact, earned him a Nobel Prize, essentially said that diversification can reduce the variability of returns without a reduction in actual expected returns. In other words, we get a better, safer rate of return if we have a reasonable level of diversification. 2 stocks is a bit of diversification, 5 stocks is better, 10 stocks is better. There's going to be a limit beyond which we can no longer really monitor stocks, and that's probably going to be no longer practical. So there's essentially going to be a reduction in that risk improvement as we go beyond a certain point. So there'll always be a minimum level of risk that we can't diversify away. And essentially that's our market portfolio. The market rate of return is the one available if we invest in all of the stocks in the portfolio, in the Standard & Poor's Index, for example. The risk, or the variance of an individual asset return can be broken down into that minimum level of risk, the lowest risk you can possibly have, the market risk, and the risk that can be diversified away, that firm-specific risk or idiosyncratic risk. So the idiosyncratic or unsystematic risk is going to diminish as we get into a larger portfolio, as opposite risks are going to offset those. And eventually the risk that remains will be the systematic or the market risk. And in Markowitz's work, he essentially said, this is what it looks like. Across the bottom of this chart, N represents the number of stocks in the portfolio. If you have 1 stock in your portfolio, you're way over here on the left-hand side. And you have a lot of both risks. We have the risk from the market. The risk from the market, R sub M. Sorry, problem with that. And that's the non-diversifiable or the market risk, or they also say the systematic risk. With 1 stock, you have a lot of the firm-specific, idiosyncratic, or diversifiable risk. So you buy 1 stock, and that stock is Tesla. The idiosyncrasy in this case is Elon Musk, the founder of the company, who does all kinds of weird things. So the share price goes up, share price goes down because he says dumb things on Twitter. Or perhaps they have a problem with one of their vehicles. They have a crash in California with one of their autonomous vehicles. Or perhaps their rock-proof glass doesn't work as well as they said it would work. Or perhaps there's a reduction in subsidies in certain states or in certain provinces. And so those are things that are idiosyncratic. They affect Tesla. They don't affect General Motors the same way. They don't affect Fiat or Mercedes or any of the other car manufacturers. So idiosyncratic is going to affect you a lot if you've only got 1 stock in your portfolio. You buy 5 more stocks and you move to the right-hand side on this chart. You've reduced the risk, and you've done it in a really significant way. The slope of that line at the beginning is really steep. That slope very steep. So two stocks in the portfolio, huge reductions. 3 stocks, 4 stocks. At some point, though, the extra benefit that you get by adding extra stocks is going to be reduced because you've already got 20 stocks or 15 stocks in your portfolio. Adding one more stock is going to provide a little bit more diversification, but we've already diversified away a lot of that risk. Now we have to offset this with the amount of work that it takes to monitor an extra stock, because now we have to read the annual reports, the quarterly reports, watch the news for all those companies. So we'll find there's going to be an optimal level. We might not hit the full market level of diversification. One exception to that. And so we can perhaps have a good portfolio with 14, 15, 12 stocks perhaps as a minimum efficient portfolio. It'd be better to own all the stocks in the market. Now we can do that with something called an exchange traded fund or an ETF. So you can buy an ETF for $30 to $200. So one stock, which is an exchange traded mutual fund effectively that's managed by a private firm who acts as the trustee, and they'll take your $30 and they'll use it to buy a little piece of every company on the stock market. And so their ETF will track the index. So essentially you buy the market with one ETF. But that's a simple example of an ETF, and it should not be considered to be stock advice. Same thing with mutual funds that track the index. They operate like ETFs, although they're generally a little bit more expensive to manage. Their management expense ratio is a little bit higher. If we want to know about the market risk and market premium, we can get that information through a number of published reports. Textbooks don't really keep up with the changes in the market premium. It does change a little bit every year, and it's going to be different for every market. So there are sources like this report that's produced every year by Credit Suisse. It's written by a group of professors and retired professors from London Business School. And it's updated every year, provides new examples. I provide an example of this or a copy of this in VIU Learn, or you can just Google the Credit Suisse Global Investment Return Handbook, and you'll get the more recent one. If you take a look at an example of how they've calculated this, essentially they've taken a look at the rate of return to stocks, bonds, treasury bills, I should say government bonds and government treasury bills, over a long period of time. Typically starting off at 1900 and working forward. It's a little bit different for different markets. For example, their China example starts off about 1978 when we start to get data, and there are gaps in the data as well. For Canada, we've got information going back before 1900. So we have a long time series that helps us to see what the average rate of return was over a long period of time to all the stocks that were traded in that national market. In Canada's case, the Toronto Stock Exchange. If you put $1 into the stock market in 1900, it went up and down a fair bit over the years, but $1 would turn into $573 by 2015. If you calculate the difference, the growth between 573 and 1 over that 116 years, and solve that for the rate of growth, that R would be the actual rate of return to the stock market. You can calculate it as well for things like government bonds, 5-year government bonds, or for treasury bills, which are very, very short-term government instruments. And you can see what the difference in that is. And that difference is the market premium. Now, I'm jumping ahead a little bit. You can see how that return works. The very long time series, and this one is from the 2016 data, or includes 2016 data. It says that over the very long time period, the first set of bar charts, the rate of return, real rate of return, and taking into account inflation, using the right-hand chart, I should say, the right-hand bar chart, was 5.7%. And so that's what we would expect to earn if we put our money into the stock market and left it there for a very long period of time. That's the average rate of return. You would also have the choice of putting your money into government bonds and taking no risk. That essentially becomes our risk-free rate. So we're also interested in what the average rate of return to bonds was, and that was 2.2%. So clearly you did about 3.5% better by putting your money into riskier stocks. And so that's your premium for investing in stocks. So 5.7 minus 2.2, accounting for a bit of rounding error, would give us a good idea of how much extra you would expect to earn for taking that higher level of risk. And that market premium over a long period of time, well, in this case they say the market premium in excess of bonds was 3.4%, and in excess of treasury bills would be 4.2%. And so that becomes the rate of return that you'd get for putting your money into the stock market, 3.4% rate of return over that long period of time. Now, they do provide us with shorter term information just to show us that in the short term the market may not be as good a predictor of those returns over the last 10 years, or perhaps a period that included a major recession. You can also get a measure of this by looking at the Bloomberg terminal, where you can see they provided us with the government bond rate, the risk-free rate. In this case, they said it was 1.89%. And then they've calculated the market premium as an equity risk premium, which they got at 4.54%, and they don't really tell us how. And they've also added in things like country premiums. So in the overall calculation of the riskiness, they go a little bit deeper into a little bit more detail. Now, that's going to take us on to the next section. And in the next session, we're going to talk about the idiosyncratic risk. And the idiosyncratic risk is essentially what we describe as the beta. And I'm going to I'm going to stop at this point because we have taken a look at the first part of our problem. What's the market risk? In the next video, we'll specifically take a look at how we measure the firm-specific or the idiosyncratic risk, and that's the beta. But the short answer to this, essentially our beta, that Greek letter B, is a measure of the covariance of the individual company I and the market. So how did the company do relative to its stock market, divided by the variance of that market. And that's what we'll come back to and look at in our next session.